Hi, I'm Patrick Farron, and I'm the Chief Investment Officer and Lead Portfolio Manager at Wealth Management International. Welcome to our 2016 Year in Review and 2017 Investment Overview and Outlook. I'd like to walk you through some of our observations about the global investment climate, as well as to discuss some of the trends that we see for various asset classes in 2017 and what the impact will be for our investment strategy. I think you'll find it an interesting and enlightening discussion. Let's jump right into our economic overview for the coming year. First of all, what I want to emphasize is that for the last several years and continuing even now, the global economy has been facing a number of very difficult headwinds. For example, slowing population growth and the associated issue of aging populations in countries all around the world, high government debt levels, lots of non-performing loans, especially in foreign banks, heavy business regulation all over the world. The fact that China and other so-called emerging markets are now past their high growth phase and are starting to grow at a much slower pace. And then finally, of course, the commodity markets that have been out of balance and exhibited excess supply and relatively weak demand, resulting in low pricing for the last couple of years. So a lot of issues that have held back growth. Nevertheless, I think a lot of people haven't focused on the fact that the global economy has been muddling through and has gradually picked up steam. In fact, the global economy is now finally not only accelerating but is normalizing. Global economic growth, and especially growth here in the U.S., is almost back to its long-term trend. It's almost back to normal. Here in the U.S., virtually all of the current economic growth is coming from consumer spending. Nevertheless, the new Trump administration has embraced policies that we think have the potential to broaden growth over time, at least in the near term. Of course, there are certain risks as well. For example, stronger economic growth could lead to increased inflation. Nevertheless, we think that those global headwinds that I mentioned a couple of moments ago will likely limit any acceleration in prices. Let's look at a couple of visual aids on our view of the global economy. First of all, this slide on global economic growth on our view of the global economy. First of all, this slide on global economic growth. The red line that you see, the horizontal red line, is the average rate of global economic growth over the last 20 years. The two gold bars at the right side of the graph show the IMF's projected economic growth for 2017 and 2018. And you can see that after a long period of subpar growth, the analysts expect that growth this year and next should almost be back to normal. If you looked at this chart for the U.S. economy, you'd see that growth is virtually right on the long-term averages right now. Well, speaking of the U.S. economy, this graph of the U.S. unemployment rate is very instructive as to how consumer spending can be so strong. A lot of that is simply the fact that the labor market has finally recovered. This graph of the unemployment rate shows that joblessness in the U.S. is now almost back down to the levels that it was at before the last recession. Looking at the next slide, this graph of average hourly earnings I think is very instructive because it shows that not only are companies creating lots of new jobs and putting people to work, but they're also finding that they have to increase wage rates to attract those workers. In fact, if you look at the blue line showing annual growth in hourly earnings, you'll see that it's well above the red line that shows the growth in consumer prices. In other words, with wages rising faster than prices, employees are seeing an increase in their purchasing power. Shouldn't be any surprise that with increased job availability, higher wages, low inflation, and relatively low interest rates, consumer optimism is pretty strong. In fact, if you look at this graph on consumer sentiment, you'll see that the index is now about the strongest that it's been in 13 or 14 years. Now, it's true that the most recent spike in this index is probably attributable in large part to the optimism about the Trump administration. Nevertheless, it actually has been strong over the last couple of years, which is what you would expect from an environment with a strong labor market. Well, of course, we don't just care about how consumers are feeling and what their optimism is. We care about what they're actually doing. And this graph on retail and food service sales, in other words, retail sales, is a good indicator that they are indeed ramping up their spending. The blue line represents the year-over-year growth in retail sales. The red line represents the growth in consumer prices. And you can see that for the last several years now, sales have been growing even faster than prices, which is another way of saying that the real increase in retail demand has been positive. Now, I mentioned that virtually all of the growth story in the U.S. right now is in the consumer sector. The industrial sector is quite a different animal. This is a graph on non-defense capital goods orders excluding aircraft, which is a proxy for corporate capital investment. And you'll see that over the last several years, the trend in this indicator is flat to down. If we look at the next slide on industrial production, we see a similar story, especially if we focus on the red line, which shows manufacturing output. Again, over the last couple of years, output has been virtually flat. A lot of the reason for the problems in the industrial sector stem from overseas. Demand is relatively weak in foreign countries. The US dollar has been very strong. There's been a lot of uncertainty holding back investment, which means that foreign companies and foreigners have been demanding less US industrial and capital equipment. If we look at U.S. exports and imports on the next slide, what's really remarkable is that even in this environment of weak demand overseas, the U.S. trade deficit has been very stable. No real growth, no real decline. What that means is that as the trade deficit has stayed stable, even though the U.S. economy has been growing, the deficit as a share of the economy has been shrinking, and that's a positive indicator for the U.S. economy. I mentioned earlier the strength in the U.S. dollar being one headwind for the U.S. industrial sector. This graph on the U.S. dollar index demonstrates just how strong the greenback is. We've seen quite a jump, especially in the period since the U.S. Presidential election. Well, let's swing now over to a discussion of the U.S. stock market. I think the key thing to remember here is that U.S. stocks remain in the same bull market that they've been in since March of 2009. The indicators we're seeing suggest that that trend is well entrenched and in place, and it could well continue. However, it is true that valuations are now elevated. We tend to favor the measure of valuations that you get from comparing the price of stocks to earnings, in other words, the PE ratio, and by that measure, the stock valuations are now about as high as they were right before the last downturn in 2007. Nevertheless, we're optimistic that continuing and potentially broadening economic growth will boost profits and allow prices for stocks to keep going higher. We're also encouraged by the fact that commodity prices seem to be stabilizing and maybe even rebounding. That'll be a good thing for commodity producers and especially oil companies. And then finally, moderately higher interest rates tend to be a positive for profits in the large financial sector. Beyond those fundamentals, we also see some good technical indicators in the market. For example, earnings per share are not yet at the extreme levels that we would associate with a potential downturn in stock prices. The yield curve still isn't steep. Transportation stocks are still leading the broader stock market, and that's been historically a good sign. And then finally, we see a decent amount of market breadth. I have a few visual aids to talk about some of these trends. First of all, in this graph on the S&P 500 price index versus the long-term average PE ratio, the red line represents the adjusted PE ratio, while the blue line represents the S&P 500 price index. What I want to emphasize here is that red line, now if you look at the far right-hand side of the graph, the red line is at almost 30, which is where it was back before the last downturn in 2007. So without a doubt, valuations do seem a bit stretched. Nevertheless, I mentioned we're seeing other indicators that suggest to us that the uptrend in stocks could continue. One thing that I look at pretty closely is whether or not earnings per share are at an extreme level and coming down. If you look at this graph, the green line represents that measure of earnings per share. What I do in this graph is I compare that with the measure of standard deviations from the average for earnings per share. And what you'll see is that typically before stocks have turned down in the past, earnings have gotten up above that red line representing 2 standard deviations away from the mean, and then come down. We see that in 2000 and then also in 2007. Well, the good news here is that earnings per share are not quite yet up to those extreme levels that have been a problem in the past. By our view, earnings per share would have to rise a significant amount further and then start down before this measure would suggest a potential downturn in stocks. And similarly, I mentioned the yield curve, which we measure as the difference between the yield on the 10-year Treasury bond versus the 2-year Treasury. The green line in this graph represents that difference, and if you look at the green line where it stood back in 2000 and then in 2007 before those stock downturns, you'll see that the green line had gotten to an extremely low level, basically meaning that short-term interest rates had risen to the point where they were virtually in line with longer-term interest rates. And that's generally been a negative indicator for stocks. Well, if you look at the right-hand side of this graph, you'll see that the yield curve is actually now right about its long-term average. And so we think that short-term interest rates would have to rise quite a bit further before this indicator would be flashing warning signs. Let's turn for a moment to foreign stocks. We currently don't have a lot of foreign stock exposure, although we do keep some in our more diversified portfolios. Part of the issue is that we see foreign companies as particularly exposed to some of those global headwinds that I mentioned early on. For example, the slow economic growth, slow population growth, low inflation, etc. Even those foreign companies that give the majority of their sales here in the U.S., however, we think even they would be sort of at a disadvantage compared with U.S. companies, simply because of the fact that there's so much enthusiasm for U.S. stocks right now that those companies that are domiciled overseas are looking less attractive simply in comparison with U.S. stocks. Nevertheless, we do pay a lot of attention to what's happening in individual countries, and there are several countries that we think could potentially buck the trend in terms of the low growth in most foreign stock markets. As you can see here, our favorites currently are Canada, Switzerland, Hong Kong, Taiwan, and India. I won't go through each one of those countries in detail, but I will give you a sense of the kinds of things we're thinking of in a couple of them. Canada is a good example. Most of the Canadian stock market is made up of energy companies and other commodity producers, and so our exposure to Canada is in large part a play on the global rebound in commodity prices. In addition, the Canadian economy has some other positive attributes. For example, the fact that the government was an early adopter of the current view that maybe they should increase their spending on infrastructure to boost economic growth. Canadian manufacturers have also done a good job of holding down their labor costs, which has made them more globally competitive. So again, we're seeing a number of reasons for optimism regarding Canadian stocks. Another good example is Hong Kong. You may be aware that the Chinese currency over the last year or so has been depreciating, and what we've noticed is that over time, when that happens, typically Chinese investors will try to get their money out of the country and in order to preserve their purchasing power. And the destination of choice for Chinese investors is Hong Kong. And so when they ship that money into Hong Kong, it tends to drive up Hong Kong asset prices. So again, a reason to be more exposed to Hong Kong stocks. The next asset class that I'd like to talk about is U.S. bonds, fixed income. Now, it's certainly true that ever since the U.S. presidential election, U.S. bonds have had a pretty significant sell-off. Bond prices have weakened, yields have gone up, and that reflects a number of concerns, some of which are more valid than others. Part of the reason for the drop in bonds is simply that there's been so much more enthusiasm for stocks that a lot of investors have sold bonds in order to raise the money necessary to buy stocks. In addition, there is a possibility that the Trump administration, if it really does loosen up fiscal policy like it says, there'd be a chance that the federal budget deficit would expand, federal debt would go higher, and the supply of bonds would rise, which would tend to drive down the value of bonds. A little bit less valid of a concern, we think, is that inflation pressures may be building, especially further up the production chain. And finally, the Federal Reserve is indeed raising interest rates. Nevertheless, we think that the sell-off in bonds has been excessive. We think a modest rebound is possible in the near term for a number of reasons. For example, the concerns about inflation seem to be excessive, given that the global headwinds that I talked about at the beginning of this presentation, we think would likely put a cap on how much the inflation rate is going to increase. In addition, the Federal Reserve policymakers continue to send signals that their intent is to raise interest rates only gradually, and we think that would help reduce the negative impact on bonds going forward. Do we see a big ongoing increase in bonds and bond returns? No, we don't do that. That's in large part because inflation, even though it's not spiking, it is coming off an extreme low, and historically, when that happens, bond prices, bond returns have been relatively muted for some time. In addition, if the economy grows faster than is currently expected, there is a risk that the Federal Reserve could accelerate its interest rate hikes. Turning to the visuals on bonds, in this graph, I show the impact or the interrelationship between inflation trends and Treasury returns. The red line here represents the annual increase in the consumer price index over the last 12 months over time. The blue line is an index that tracks total returns on Treasury bonds. I think the thing to look at here is, for example, in the 2003 period, inflation had gotten extremely low and then come up, and once that happened, the total return on treasuries was basically flat for several years. We saw a similar thing after the extremely low inflation rates in 2010 and 11, which tended to hold treasury returns flat in 12 and 13 and 14. And what has us concerned now is that inflation once again is coming off an extreme low, and we think that will limit the total return on bonds going forward. So in sum, we think there's a chance that the bond market will stage at least a partial rebound in the near term, but we're not looking for extremely strong bond returns by any means. We still think bonds have a place in a lot of portfolios, for example, to produce some yield or to reduce the amount of volatility in a portfolio. Nevertheless, we're not overly enthusiastic in bonds at this point. Finally, let me say a word about alternative asset classes. Over the last year or so, we've put a lot more attention into the alternatives, both in terms of real estate and commodities. Now, in real estate, I want to emphasize that what I'm talking about here is publicly traded real estate investment trusts, not the illiquid kinds of REITs that you can't sell. I tend to favor the publicly traded REITs for their liquidity and their historically good performance. In the current environment of moderate and possibly accelerating economic growth, we think that's a good fundamental environment for REITs. For example, as the economy grows, we would expect there to be increased demand for everything from retail properties to hotels to warehouses to healthcare facilities. And that would tend to support rents and ultimately the dividends that come from these REITs. Nevertheless, there is a concern that rising interest rates could be a negative for REITs. Rising interest rates will tend to hurt REITs for a couple of reasons. First of all, it's simply the fact that higher rates, higher yields on bonds make them relatively more attractive. A lot of investors will say, well, if I can get a decent yield on a 10-year treasury bond now, with all the safety implied by treasury bonds, why wouldn't I just buy that instead of a REIT? In addition, higher interest rates make it harder for REIT companies to invest in new properties that would allow them to increase their dividends in the future, and that would also tend to be a negative for REIT prices. Turning to physical commodities, we're cautiously optimistic on a number of key sectors based on our expectation that production will continue to be limited even as global demand rises moderately. Crude oil is a great example, especially given that it's a major component of most of the broad-based commodity funds. The key thing here is that OPEC and a lot of other foreign oil producers late last year agreed to limit their production, to actually cut their production in 2017. And earlier indications are that they're having some success in doing that. In addition, there's been a lot less investment in new exploration and development over the last few years in response to the low oil prices, and over time we think that is likely to be a positive for oil prices. Sort of a similar story in natural gas, where demand is rising, especially for things like electricity generation and now exports of natural gas. At the same time, output has been relatively limited, and we think that's going to be a positive for natural gas prices going forward. Industrial metals, a similar story, especially if increased investment in infrastructure, not only in the United States but overseas, really happens, then that will tend to be a positive for things like iron and zinc and other industrial metals. However, precious metals we think will be facing headwinds because of the rise in interest rates and less interest in safe haven buying as people get more optimistic on the economy. Finally, in agriculture, we want to be positioned for a potential turn in the weather that's going to allow agricultural prices to rise again. We've gone through a very strange and unusual period of 4 straight years of extraordinarily good weather globally for agriculture, and that's really boosted yields and production and driven prices downward. We think that the weather's got to turn at some point, and we want to be well positioned in commodity funds in order to take advantage of that, because it would tend to drive prices higher when the weather turns again. In terms of the visuals, just a couple on alternatives. First of all, this graph on U.S. domestic crude oil production. You can see that U.S. production has fallen off pretty significantly since its last peak back in the middle of 2015. Output's down almost 10% since then. We are paying attention to the little rebound that you see there, most recently at the right side of the page. That has the potential to offset some of the reduced output in the OPEC and other foreign producing countries. It's something we're keeping our eye on. Nevertheless, big picture wise, we still think that globally rising demand coupled with muted to decreased production globally will tend to support prices and allow the upward trend in oil prices to continue for a while longer. Finally, I mentioned agricultural prices in this graph on global corn supply and use. If you focus on the blue and the red lines, which show supply and demand, you'll see this extraordinary period of excess supply over the last few years. We believe that at some point weather patterns will normalize. We'll get drought or some other issue in major producing countries that will tend to allow prices to increase again. And so we want to be positioned in commodities, at least to have a moderate position in broad-based commodity funds in order to potentially take advantage of those trends. So that wraps up our 2016 overview and outlook for 2017. We hope that you found it enlightening, and we look forward to continuing to serve you by growing your assets and working to protect your assets with our investment strategy. Thank you.